Jonathan, the first law firm in the world to list its shares, Slater and Gordon, has found those shares cut in half today. Millions of Australian dollars disappearing in a puff of legislation. Who do we sue here?
Well, you've got a choice of culprits. So the first person you could sue is the Chancellor of the Exchequer in the UK, George Osborne. Although Slater and Gordon is listed in Australia, large parts of its business are right here in the UK. And yesterday in the autumn statement, Mr. Osborne said that he wanted to clamp down on what he regards as frivolous personal injury claims that are clogging up the courts and escalating the cost of insurance.
We call that ambulance chasing.
Ambulance chasing, that's right, or Florida neck, as I think it's known as well. You have some other choices though. You could sue short sellers. Almost a fifth of Slater and Gordon's shares are sold short, so that exacerbates volatility in the shares. You could also have a pop at the Australian Securities and Investment Commission because they're currently conducting a probe into Slater and Gordon's accounting, and I think that the concerns over the recognition of revenues particularly are something of a big factor behind the fall in the shares.
The natural question to ask at this point is whether a law firm is the type of business that should have a public listing. Is this a case where they just made a structural error?
That is a tempting question to ask, and there are lots of people wagging fingers and saying, "Oh, I told you so, you should have remained a partnership and keep it all nice and cozy." I don't think, though, that in this case it's really about the structure of the company. I think it's more about the management and the strategy and the way they've gone about that strategy. It's fairly typically in these sort of industries, it's a consolidation strategy. So they float on the stock market and they say, we're going to buy up lots and lots of smaller legal firms. It's a very fragmented industry. We're going to consolidate it. And having a stock market listing gives you an acquisition currency with which to do that. The funny thing about Slater and Gordon is that they haven't really done that. Many of their biggest acquisitions have been part funded or wholly funded by cash. And in fact, the biggest acquisition they've ever made, which was the professional services division of a UK company called Quindell, which has also had concerns over its accounting.
It certainly has.
Was made entirely for cash, not for shares.
So the question is whether the company can survive the shock that it received yesterday as reflected in the crash in the stock price today. What do you think?
I think it possibly could. I think the thing in the UK over the personal injury claims is a bit of a distraction. It's a consultation that won't report for many months. So any impacts on earnings will be some way out. But I think what the company really needs to do is get on top of these concerns about accounting. We see this over and over again. The company, if there are concerns about accounting, revenue recognition, short sellers get stuck in and they don't let go until those questions are cleared up. So I think that's the thing they really have to do. But the shares now are at 94 Australian cents. The company IPO'd in 2007 at $1 a share. So clearly they've gone all the way back down, having peaked at over $8.
Thanks, Jonathan.